Alright class, welcome to chapter 4. We just made it through chapter 3 where we were analyzing different business transactions and figuring out which accounts were used and what direction, if those accounts are going up and down. We're going to continue working a little bit in that in chapter 4, but we're going to expand our list of accounts. We're going to create first what's called a chart of accounts. The chart of accounts is basically a list of all the accounts that you would use for the various transactions of your business. So if there's a certain type of account or category that's used more often, you would make an account for that so that you can keep an eye on it, you can analyze and keep track of everything that takes place in it. The chart of accounts is separated into the same classifications. You have your assets, liabilities, owner's equity, and now we're going to add two more. We're going to add your revenue accounts and your expense accounts. This is a good way to keep organized and keep track of everything inside of your business. The next thing that we have is a system of numbering. This makes it easy to locate or to find the different accounts. We call all the accounts put together and organized, we call that a ledger. It's a group of accounts, also referred to as a general ledger. This is where you keep all of your accounts for easy access, for reference, so that you can get to them when you need them, analyze. It's almost like in a library where you would find the different books categorized by topic or maybe by author. In accounting, we do the same thing. We organize all of our accounts so there's easy access, we can get to it, get the information that we need quickly and efficiently. Alright, and this is how we do it. All the different account types, assets, liabilities, owner's equity, revenue, and expenses are giving numbers. And all the different types start with the same number. For example, your assets would all start with the number 1. Cash and bank, accounts receivable, computer equipment, all of them begin with the number 1, so you can easily find them and see that they're assets. Your liabilities will begin with the number 2. So all the people that you owe money to, all your accounts payable, will begin with the number 2. Number 3, we have our owner's equity accounts, the capital account, withdrawals, and also income summary that we'll talk about a little bit later on in this course. Those begin with the number 3. Number 4 is reserved for our revenue accounts. That's when we provide our service or we sell goods to somebody. Those account titles where we keep track of the sales would begin with the number 4. And last are our expenses, which begin with number 5. So we can go through the list of all of our expenses and locate them based on their numbers. So this is universal. It's just one of those language things in accounting. So this is the way that we always classify the different chart of accounts. The nice thing in accounting is that when you go to analyze, it's almost like matching or multiple choice. Your chart of accounts are your options. Those are the accounts that you get to choose after you go through the transaction about which one would be affected. So you look through them and you say, this best describes the transaction or the account that would be affected, and then you go ahead and you record the transaction inside that account. Okay, let's keep going. So, the T-chart. The T-chart is something that we use in accounting to analyze transactions. It's a great friend, a great tool to use. It's not necessarily a legal document or anything, but it's what we use to determine which accounts are affected and which way they are affected. So there's a couple of new terms that we're going to be discussing in chapter 4. The first one we're going to talk about is double entry accounting. This is the system used, again, to analyze transactions, to record them. Double entry accounting is simply, there are 2 accounts that are affected. It's a system we use to analyze. 2 accounts, there's always 2 that need to be affected, at least 2 in every transaction. The next would be your debit. A debit in accounting simply means left, or left side of the T-chart. It doesn't matter which account it is. It can be an asset, a liability, owner's equity. A debit, though, always means the left side of the T-chart. And a credit would be the opposite. A credit would mean the right side of the T-chart. The way that I think of it, and maybe it's silly, but I always try to think, when I was in high school taking accounting, where's the White House located? And if I could remind myself that it was in Washington, D.C., I always took that D.C. and took it out, knew that D came first, it was on the left side, and C came on the right side. Maybe silly, may not help, but it was a simple way for me to always remember debits are always on the left, and the credits are always going to be on the right. So let's begin by talking about how it affects. So your T-chart here, to set it up, you would put the name of the account up top. So you would start by putting the name of the account up top. Then on the left-hand side, you would put debit, and on the right-hand side, you would write the word credit. So this is basically just a way for you to begin. You write the name on top, left side is debit, and the right side is credit. Every account gets set up the same way, exactly like this. It does not matter if it's an asset, a liability, or owner's equity. It's always debits on the left, credits are on the right, name of the account on top, and there are at least 2 accounts that are going to be affected by every single transaction. Alright. So, the normal balance. This is a term that's going to come up a lot. You're going to be asked, what's the normal balance of the cash account? What is the normal balance of an accounts payable account. And all the normal balance means is it's the side that that account would increase on. So if you were to look at your asset accounts, now assets, when they go up, you would write that amount on the debit side, on the left side. So that would be considered the normal balance side. For example, cash is an asset, right? And cash is constantly going up or going down inside of your business. So if there was a transaction where cash was increasing, maybe you had a sale or maybe an investment and cash was going up, and let's say that cash was going up $500. You would then go ahead and write the $500 on the debit side, on the left side, because that increased the cash, okay? Let's assume that this is your cash account, okay? But if you go and you pay a bill, let's say you pay a bill for $300. In that case, your cash would actually be decreasing. So if it's going down, if the increase side is debit, guess what? If that account goes down, you have to write it on the opposite side. So the decrease side for an asset, such as cash, would be the credit side or the right side. So you would simply write the 300 on the credit side, showing that that account decreased. That's the difference. The normal balance is anytime that account goes up, that's the side that you would write it on. Okay? Now different accounts go up on different sides, and we're going to get into that in a minute. So here it is. The name of this site and the name of a lot of the things that we do in this class is dead coil. Now I'm going to get into it and explain to you exactly why we use dead coil and what it means. So the first thing we're going to look at is the word dead. Okay? First thing we're going to look at is the word dead. The D in dead stands for debit. What this is going to tell you is that all the types of accounts that fit under the word debit in dead means that those accounts, when they go up, you write the amount on the debit side, on the left side. Okay? So the first one we're going to talk about, so you have D for debit, you have E for expenses. Anytime an expense goes up, you would write that amount on the debit side, on the left side. The A would stand for assets. Anytime an asset goes up, you write the amount, the value of it, on the left side or the debit side. And last, we have drawings, or what we've called withdrawals. It's the same thing, drawings and withdrawals. So anytime a drawing or withdrawal takes place, you would also record that on the left side or on the debit side. So all three of these, their normal balance side would be considered to be the debit side. They go up on the debit side. Now let's look at the other one, coil, right? The C in coil stands for credit. So all the accounts underneath credit, or the C in coil, are the ones that when they increase, you would write the amount on the credit side. So the O in coil stands for owner's equity. That's our capital account. When capital increases, we would write the amount on the credit side. The I stands for income. Income are our revenue accounts. Anytime revenue goes up, you would go and you would list that also on the credit side. Anytime we have revenue and increases, the normal balance, the increase side, is credit. And then finally, the L stands for liabilities, our accounts payable. When we owe more money, when our liabilities increase, we would write the balance, or we would write that amount on the credit side. Now, just like all of these go up on the credit side, if any of them go down, you would write the amount on the other side. So liability, accounts payable, when you pay off the money you owe and the account decreases, you would actually write the decrease on the debit side. Cash, if cash, because it goes up on the debit side, if you spend cash or cash decreases, you would write that amount on the credit side. So they crisscross when they go down. This tool is used to tell you which side that they go up on, which side that they might increase on. So you can see here that they all increase. Oh, sorry, my eraser's not working. On the side that they're lined up, but when they go down, they crisscross and they do the opposite. So that's your debit credit theory. So let's look at some of the rules real quick. First rule for asset accounts. Asset accounts increase on the debit side or the left side. They decrease on the right side, on the credit side. But their normal balance would be considered the side that they increase on. So for assets, debit would be their increase side. The normal balance is the increase side for debited accounts. The other category we're going to look at, liabilities and owner's equity, are capital accounts, right? So these all increase on the credit side, the right side. So if you have an increase, you would write it on the right side of the T-chart, on the credit side. If they decrease, you would write it on the left side or the debit side. And then finally, if you're asked what the normal balance is, again, normal balance, all it means is the side that that account increases on. In this case, it would be the credit side for our liabilities and for our owner's equity accounts. Okay, so that's pretty much the beginning phases of starting to analyze using T accounts, using the debit and credit theory. Continue to practice it. Tomorrow we're going to go over some actual transactions where we're analyzing the two accounts side by side and going through how they're affected, debit or credit. Okay, thank you for watching this video.